Should you try and pick individual stocks or just buy an ETF? That's what we'll discuss here today. This goes for your investment portfolio, but it might be your retirement account as well. My name is David Quintieri, and I have been involved in the financial system for well over a decade. I've written 2 books on the subject, and I have been knee-deep in the trenches each and every day, taking what's all real complicated and making it so simple to understand for anybody. So what we want to look at here is this question of what should I do with my money? And it is very important that we understand the pros and cons and that we look at this on a deeper level. That's what we're here to do today. So let's begin. I want to make it clear right up front that we are specifically comparing paper assets. So within that world of paper assets, this information will apply. Most people, let's say it right now, most people cannot predict the market accurately. You can try, but you will likely fail. And I want to make this clear as well, over decades. You can't just rely on being an accurate investor, this month, this year, or even through this one cycle. It has to be over a series of decades, or those losses are going to be magnified. Maybe you got lucky, maybe you did well, maybe you invested in tech stocks, maybe you bought that Tesla. And you see that with a lot of YouTubers who became very popular because of one particular trade. Maybe it was Tesla. And now suddenly they're a genius. Oh yeah, they got the nice house, the nice car, all because of that one bet. And then they did maybe a few others on top of that. Some you win, some you lose. But without that one outlier, they wouldn't have done real well. Now, is that a genius? Is that somebody who knows a lot of stuff? Or is that somebody who took a risk and really did well? Now, that's great if they can do that. But what we want is more of a guarantee. For the average person, we've just got to realize how much time are we going to invest into learning about these things, keeping up to date, looking at the financials of companies, and trying to just really decode what's happening in the global economy at any given moment. All those things are going to affect that stock. So you got to be aware of this, all right? And so I will say that for most people, it is better to hold an ETF, broad-based overall market. And that's a simple matter of fact. It is a simple matter of fact. You're going to get lower returns than some stocks. Some stocks, depends. There's less downside potential. So this is what we must realize here. You're probably not going to be able to pick all the right stocks at all time. So you're going to lose some. And that means your portfolio is going to drop. Now, how much did you apply to that out of the total pie? Is that 5%? Is it 10%? Is it 20%? Whatever the case may be. A lot of these companies, you think it's going to go well and it just keeps going down. Some people, they double down. Oh, I know, I'll double down. All right? No. A lot of times that just makes things worse. We got to know when to hold them. We got to know when to fold them. You got to know when to sell. But people don't. So if we hold a broad-based ETF over a longer period of time, that's going to be able to benefit a vast majority of people. It's like holding a mutual fund, but with a lot of these ETFs, the fees are much, much lower. You got to think about the different sectors. So for instance, you could be going through a recession, and that recession, for whatever reason, makes people put more money into value stocks, what they think are going to be there for a while. Maybe that's like Johnson & Johnson, Coca-Cola, all these different companies that they sell household products that people will buy whether there's a recession or not. And so that's an important thing. That's a very important distinction. Depends on the circumstances, right? So as you look at it, breaking it down by sector, you can say that, okay, some sectors will do better than others. So in that period of time, if I'm holding the broad index, it's probably not going to go down as much as if I just pick one sector or one stock within that one sector where the drop could be magnified tremendously, 70%, 80%, 90%. This happens. Okay, right in the cycle, big name companies were losing that much money. And those were the ones, the darlings, as they call them, that were doing so well. And then, we got a problem here. So understand the different sectors and why, for most people, if I just go broad-based ETF, that's going to help them a lot. That's going to make it a lot more simple. You don't have to get a mutual fund because generally, if you buy a broad-based ETF, you're going to outperform the mutual fund. So don't pay that 2%, 3%, 4%, and who knows what they're charging. Now, if you have some specialist, if you're working with some sort of special, he's got some gift, different story. They've got to have that track record, and they got to have that track record for, over 20 years. If they don't have it over 20 years, I wouldn't go with it. Broad-based ETFs probably going to do better. And even if it doesn't do better, you know that you're holding onto something that is definitely going to weather the storm better than the average stock or the average investor. Chances are that's the way it goes. Now, holding stocks should not be viewed as a money maker. It's a wealth preserver. Okay, that like a lot of people don't realize that because they watch these YouTube videos, they get confused. You're putting money into something and it's going to earn you 5%, 7%, 10%, whatever the case is, okay? You want to do this, you want to invest in something that of course appreciates over time and hopefully, you can do well over a period, make more than you would on your money. Okay, so you're earning, let's just say $100,000 a year. You take, I'm going to invest $10,000 a year. You take that 10,000, okay, it becomes 11,000, it becomes 12, and you just keep recycling that over and over again. And, by the time you're ready to retire, you have a nest egg. Okay, that's okay. But you want to not live a life that you got to, basically just conserve so much and then you become 65. Maybe you don't even get to 65, God forbid, right? You want to be able to accumulate that wealth faster. And that's why I say you got to make money in business. Business allows you to do that, where you can accumulate cash much faster and then you park it in what I call, or preserved capital, in traditional assets. Whether you like stocks, whether you like bonds, real estate, precious metals, whatever it is, that's what you've got to do. You park the cash in those traditional investments. But I have concerns about this. ETFs are heavily concentrating stocks into the biggest names. The biggest stocks, as you see right now, there's more passive investing than active investing. A lot of people are putting that cash into the ETFs, and for good reason, okay? Because they're going to outperform the average mutual fund. They're going to outperform your average financial advisor, okay? And why? Because they only care about their fees. So it's obvious. But at the same time, you look at this and you see the concentration. So what happens is when they're buying, if they're creating an index on their own, they're going to be buying more Apple than they are of anything else. So they're making Apple bigger than what it might really should be. And they've always got to do this, right? They've always, if a whole bunch of people sell, then that has a cascading effect. Just like if everyone exits that ETF, it's going to unwind very badly. It's going to be very dangerous. We've never seen anything like that, but that is a huge concern. If people start to go out of the ETF. Oh no, we don't trust Vanguard for whatever reason. Maybe there was like a scandal inside, who knows? Oh, they don't actually do it in some way. There's something with the SEC, like who knows? And a whole bunch of people rush for the exits. This is going to be like very dangerous. And that's why we shouldn't put everything all into one, not one company, not one particular ETF. But certainly look around, because I think that is another one of the concerns that isn't talked about. I've asked at least 2 people that I've interviewed about this, and I don't know if they really grasped what I was talking about, but I think that's a big concern. That's a lot of money, so that there's a lot of liquidity there, but if there is a problem that comes up, I think it could be very devastating for that particular ETF, for the investors involved, and also just, quite frankly, for the entire market, because it's so heavily concentrated. So this is my explanation of what I think people should do the average person. It's not to go out there to your advisors and give them that, 5% or whatever it is. And by the way, they might tell you it's 2%. There's the hidden fees. All ETFs have hidden fees too, by the way. Don't believe the nonsense. But they're generally much lower fees than you would at like a mutual fund or financial advisor. So this is the point I'm trying to make here. And you go in and you do what you have to do, but don't try to make your money. It's like, I talked to one guy, poor guy, and he was in a financial predicament, and he said to me, I just really, really need this to work out. And that I kind of stopped myself. I said, yeah, but okay, be careful now. Do not go with that mentality because you could really burn yourself, okay? And I don't think I think he was desperate. And so that's not the case. You don't just go all in on something and hope, okay, I hope I don't ruin my life right now. I mean, that's not a good thing. You got to get out there. You got to knock on doors. You got to phone calls. You got to do emails. You got to make things happen for yourself. You can't just say, I'm going to bet on this stock, because you're putting your money, all your savings, your earnings, whatever it is, into somebody else, into another company, into somebody to say, hey, I love this stock. So then it promotes it, and then the cash goes that way, and then, oh, I'm successful. It's a cryptocurrency. Who's going to pump it before they dump it, and I can hopefully ride that train? I don't want any part of that. I put the hard work into myself. I make those things happen. I'm willing to do what it takes. Are you? You let me know. ETFs, individual stocks, what do you think about this? Put your comments down below. Let me know what you think of the anecdotes that I'm talking about today, the people who are just taking all that risk. Is that you? Do you know somebody like that? I want to know your thoughts. Put it in the comments below. Hit that thumbs up. And of course, as always, I'll see you tomorrow. Take care.